Oil just had one of its biggest single-week collapses in years. WTI crude dropped 9.5% this week. That puts it at roughly $75 per barrel, the lowest price since early March. And the reason is something markets have been waiting for. The United States and Iran signed a memorandum of understanding. It opened a 60-day window for formal negotiations. Vice President J.D. Vance confirmed it publicly. More than 12.5 million barrels passed through the Strait of Hormuz overnight, and oil traders responded immediately. But here's what history actually says about moments like this one. Every major oil price drop tied to geopolitical de-escalation since the early 1990s has eventually reversed. Not always, not immediately, but the pattern is striking enough to pay attention to. And right now, the 60-day negotiation clock has barely started ticking. So before you assume $75 oil is the new normal, let's look at what the data is actually telling us. Start with what happened this week. The U.S. and Iran did not sign a final peace deal. They signed a memorandum of understanding. That is the financial and diplomatic equivalent of a term sheet. It says both sides agree to talk. Technical negotiations are scheduled to begin this weekend. Meanwhile, Israel continued strikes on Lebanon. Questions remain over the future of Iran's nuclear program. These are not minor footnotes. They are the core issues that caused the conflict in the first place, and none of them have been resolved. The market priced in the best-case scenario immediately. That is how financial markets work. Good news gets priced in fast. Bad news tends to arrive slowly and then all at once. Now here is where the historical pattern becomes important. Think back to the first Gulf War ceasefire in 1991. Oil had spiked during the conflict. When the ceasefire came, prices collapsed quickly. But within months, production complications and new regional tensions pushed prices right back up. The same pattern played out after the 2003 Iraq invasion ceasefire period, and again during the 2015 Iran nuclear deal negotiation. Every single time, the initial relief rally in energy markets gave way to something messier, not because peace deals are bad, but because energy markets run on certainty. And a 60-day negotiation window is the opposite of certainty. Here's what that means practically. The oil price drop you are seeing right now is real, but it may be borrowing from future stability that has not been earned yet. Hold that thought, because there is a second layer to this story that connects directly to your household finances. The Federal Reserve is watching oil prices closely right now. This week's data from Edward Jones confirmed it. The Fed's preferred inflation measure, the Personal Consumption Expenditures Index, has been rising. Energy prices have been one of the key contributors. So when oil drops 9.5% in a week, you might assume the Fed gets breathing room. Inflation falls. Rate hike pressure eases. But here is the complication. Core PCE inflation, the version that excludes energy, is also rising. Services inflation has not reaccelerated meaningfully, but goods prices are firming up. And the Fed's new chairman, Kevin Warsh, has made clear where his focus is. Every time the conversation turns to the Fed's dual mandate, his emphasis lands on inflation. Not jobs, not growth, inflation. So even with cheaper oil this week, the broader inflation picture has not changed enough to shift Fed policy. Markets are already pricing in a higher federal funds rate than the Fed's own projections suggest. Short-term bond yields have risen from recent lows, and cash yields are declining as the Fed's prior rate cuts work through the system. The gap between what markets expect and what the Fed projects is widening. That gap matters for every person carrying a mortgage, a car loan, or credit card debt. If you are finding this useful, consider subscribing for more practical financial insights. Let's bring this back to what you actually control. Oil at $75 per barrel does reduce energy costs for consumers in the short term. That is real money back in household budgets, but the 60-day negotiation window creates a specific risk profile that most financial commentary is glossing over. Here is what that window actually looks like in practice. Negotiations begin this weekend. Iran's nuclear program remains the central unresolved issue. Israel's continued strikes on Lebanon introduce a wildcard that neither the U.S. nor Iran fully controls, and energy markets will reprice instantly if any major breakdown occurs. The Charles Schwab Weekly Outlook noted this directly. Oil responded positively to progress, but the issues still needing resolution during the negotiation period are significant. That is careful language for something straightforward. This deal could fall apart, and if it does, oil does not drift back up gradually. It spikes, because traders who sold this week would need to buy back fast. That kind of reversal hits consumers within days at the gas pump. It hits airline ticket prices within weeks. It hits grocery costs within a month. And it gives the Fed exactly the ammunition it does not want right now, a reason to raise rates rather than hold them. There is one more dimension worth understanding. The cryptocurrency markets are also feeling this week's energy price move. Strategy's preferred stock issuances, tracked under the ticker STRC, fell to $83 at their lows this week, the steepest discount to par value since the security was issued. Bitcoin remains near its 200-week simple moving average. That level has historically marked the floor of bear market cycles in crypto. The connection between oil, inflation, and digital assets is not always obvious, but here is the link. When energy prices are volatile and inflation is elevated, risk appetite across markets compresses. Crypto, growth stocks, and speculative assets all feel it. When oil stabilizes and inflation expectations ease, money flows back toward risk. The oil price this week created a momentary relief signal, but the 60-day window means that signal is on trial, not confirmed. So what do you actually do with all of this? First, do not make major financial decisions based on 1 week of oil price movement. The structural picture has not changed as dramatically as the headlines suggest. Second, if you have been waiting for lower energy costs to show up in your monthly budget, this week is real. Enjoy it, but plan around it being temporary until negotiations produce something binding. Third, if you hold energy sector exposure in your portfolio, understand what you own. A peace deal that holds could compress oil prices for months. A deal that collapses could spike them within days. The risk profile right now is genuinely two-directional. Fourth, watch short-term treasury yields closely. If oil stays down and inflation data softens, yields may ease. That directly affects mortgage rates, business loans, and consumer borrowing costs. But if oil reverses and inflation picks back up, that ease disappears fast. The bond market will tell you which direction this is heading before the headlines do. That is what the data is showing right now. What you do with that information is up to you. The next 60 days in oil markets will tell us a lot about 2026's second half. Stay close to it.